Hello, everyone, and welcome to our Distress Turnaround webinar panel, moderated by George Blanco of Avant Advisory Group. We will begin the webinar shortly as we wait for a few more to join us. Hello and welcome, everyone. Thank you again for joining us on the webinar today. My name is Kristen Siegel, and I manage events here at Axial Markets. We are thrilled today to be hosting this webinar in collaboration with Opus Connect and Venable. Before we begin the presentation, I would like to give a quick overview of Axial Markets. For those of you not familiar with it, we are a network of over 10,000 accredited and active deal professionals. We help connect all types of private market participants around live and relevant transactions. Examples of our members include investment banks, private equity firms, lenders, corporate development offices, and high net worth individuals. Our goal is to facilitate new relationship building, more easily manage existing relationships, and ultimately close more deals faster. For today's webinar on distress turnaround, we are happy to have George Blanco, Managing Director at Avant Advisory Group, moderate the panel. Our panel includes Suzanne Yoon, Principal at Versa Capital, Gail Bernstein, Executive Vice President at PNC, and Carolyn Kalari, Partner at Venable. Please feel free to send us any questions that arise throughout the course of the webinar via your chat box, and we will try to answer them. We will also leave time at the end of the presentation for any additional questions. With that, I will turn the floor over to George, and as mentioned before, please feel free to send your questions to us throughout the presentation.
Well, terrific, and thank you so much. First of all, I want to make sure that you can see our presentation, so please confirm that. I think it's coming up now. Can you see it okay?
Not yet. That's the loading.
There we go. It should work now.
Yes.
Well, terrific. Well, hello and welcome to our panel on distressed investing and turnaround restructurings. And it's about finding hidden value and preventing surprises. By way of information, the economic recovery is not salvaged underperforming companies. There are more defaults on the horizon as companies lack liquidity, their capital structures remain over-leveraged, and expected sales increases have not transpired. Beyond companies with a hole in their capital structure, there are still a lot of zombie companies that can be returned to life. Where do you find them, and how do you return them to value, are some of the questions we'll address today. Our panel of experts will discuss why they focus on distressed assets, the opportunities that exist for investing in distressed assets, and the issues to consider for those entering this space. Next off, I'd like to introduce our panelists, beginning with Carolyn Kalari. And a focus in business law, complex litigation, intellectual property rights, and regulatory and government affairs in particular. Carolyn is a partner in the business division of Venable. She's distinguished by her energy, her dedication to clients, and her deep understanding of their business goals and objectives. Carolyn works with executives as an in-house counsel and with private equity firms with their portfolio companies. In particular, her background is with distressed assets, corporate bankruptcy, restructurings. She has an extensive background in sophisticated reorganizations, working across the full spectrum of Chapter 11 cases, as well as out-of-court workouts and other ways to acquire assets. She was a member of the corporate restructuring group at Willkie Farr for 14 years prior to joining Venable 5 years ago, and has extensive experience with some brand name clients, including XO Communications, PG&E National Energy Group, Extended Stay, Lehman Brothers, and a number of other brand name clients. In terms of recent transactions, she's been involved with everything from $5 million in acquisition value to a current transaction that is well over $300 million in transaction value. Next up, I'd like to introduce Gail Bernstein of PNC Business Credit. I've known Gail for a little while. I consider her to be a rock star lender and a Renaissance woman. She's assembled a banking team that is in the process of, I think, becoming legendary in the West Coast. They're some of the most experienced bankers in the West, and they're helping finance some of the most complex and interesting deals in the middle market today. Additionally, she has an extensive wine collection of over 500 bottles and understands drama. She's got some of the best tickets to the Hollywood Bowl and the Mark Taper Forum in Los Angeles, and previously had experience in high school plays and in college. Gail is currently Executive Vice President, Western Region Marketing Manager of PNC Business Credit, headquartered in Los Angeles, California. Prior to opening the PNC's Business Credit West Coast office in 1998, Gail was the National Sales and Marketing Manager for Wells Fargo's ABL unit, and beyond that has a very extensive background in ABL lending. Her career encompasses a specialization in international lending and investment management. She has traveled extensively in Latin America and is bilingual. She has an MBA from the University of Southern California and a BA from Loyola Marymount University. Next up is Suzanne Yoon. She's a principal and responsible for transaction development at Versa Capital Management. Suzanne has more than 14 years of experience in special situations involving corporate finance, capital markets, restructuring, and advisory. Most recently, she was Senior Vice President of CIT's National Restructuring Group, and previously she co-founded LaSalle's Business Credit and ABN AMRO's Corporate Restructuring Group. Suzanne's career has also incorporated time at Ernst & Young's Restructuring Advisory Practice and in distressed loan portfolio management at LaSalle Bank. She holds an economics degree from the University of Iowa, where she met her husband and didn't start dating until 8 years afterwards. She's the mother of 2 children, but she travels extensively and manages to balance all that somehow. But she has a unique insider's view into buying distressed assets because of her background. With regard to Versa Capital Management, the targets range from companies that are $50 million to $1 billion in revenue. They typically invest anywhere from $10 million to $100 million in their investments, and they have $1.2 billion under management. With regard to myself, Avant Advisory Group is a middle market restructuring practice that also provides consulting services to clients. We have 5 core competencies, including restructuring of financial and operations, business enterprise improvement, CFO services, fraud and forensics, and quality of earnings. My background also includes having been a partner at PwC, BDO Consulting, and I've run a number of companies in addition to having been CRO for dozens of other companies. In terms of information that we'll be covering today, our general topics for discussion are going to include general conditions of distressed assets, sourcing deals, determining how much to pay in terms of valuation, best options for purchasing assets and how to structure, financing options and structures, how to make acquisitions, and we'll try and provide you some key takeaways today. In terms of setting the stage today, I'd like to allow each of our panelists a couple of minutes to talk about a couple of things. One is, how do they view the overall state of the market, and how does it impact the opportunities for distressed investing? Suzanne, could we start with you and talk about how you view the market with Versa? I know you travel around the country, see hundreds of deals literally each year. Can you give us some perspective on how you view the market and how it looks for distressed investing today?
Thank you, George. I think it's a really interesting market. because I think we at Versa have been slower than we've been actually in a number of years, and I think it relates to a couple of issues. One, post 2009, the market crash in 2009, we've seen high yield basically flood the market to take over. Really, the lack of capital due to the regulatory environment for banks. So I think banks really tightened up their lending in 2010 and 2011, which really opened the way for the high yield market. And on top of that, there was an inflow of BDCs and non-bank financial institutions entering the market for lending. So, and not to mention, there is a interest rate that basically is non-existent today. So it's really allowed companies to borrow money and to borrow money without the high interest rate costs that really I think we should probably start anticipating in the next few years. So the default rate is at all-time low. And really for distressed investing, particularly in the private equity space, it's very driven by where the default rates are and whether the banks are needing to exit. So, what we would say that we're focused on now is really looking for the non-cyclical distressed opportunities, which basically result from bad management, fraud, and then some industry cyclicality.
Terrific. Carolyn, can you give us some perspective as a bankruptcy attorney on what you're seeing in the market and opportunities for distressed investing? Carolyn?
I'm sorry, can you hear me now?
There you go.
Okay, so I need to echo what Suzanne was saying with respect to what the market looks like. Right now, the bankruptcy filings are very low. We saw an uptick in 2009 and 10 a bit, but with the interest rates being so low and bankruptcy being an expensive alternative, lenders are finding different routes for capitalizing on their investments. We've been doing a lot more of out-of-court workouts. We've been doing a lot more of, when we're representing the lenders, just doing foreclosures or even deeds in lieu, other alternatives like Article 9 dispositions. So bankruptcy themselves, while we have an increase in liquidity now, which was an issue for us right after the burst, there was a time lag where there weren't bankruptcy filings, and people would say, why? And I said, well, you actually need liquidity to file for bankruptcy. We have that now. We have plenty of liquidity in the market, but with interest rates low, we have a very low default rates, and so borrowers are able to come up with different strategies rather than filing for bankruptcies right now. But as soon as interest rates turn around and defaults start to increase, that will hopefully, for our sake in the industry, turn around as well.
Terrific. Gail, and I know you've had essentially a record year last year, and I think you're busy again at the start of this year. What kind of deal flow are you seeing, and how do you view the state of the market when so many others are having trouble finding deals to initiate and to find distressed deals to acquire?
Well, I think 2012 in general was pretty robust, and I think there have been, as someone had already said, there's been a lot of new entrants into the marketplace, some new BDCs, and you have various private equity firms now having a lending arm like a Golden Gate, Goldman Sachs. And besides, all the banks have cleaned up their portfolios, and well, we have seen some activity in the first quarter. I actually got sent something this morning from Reuters, and they said that in the first quarter there's been 156 billion of financing, but only 21 of it came from M&A activity, and that there's very little new money. That it's basically been the market's been refinancing, and I prefer to work on something that has an event. Somebody's making an acquisition, or somebody bought a company where it just didn't work out and they're divesting of it because really it's a borrower's market, in that no bank, even if they have them in workout and said, go find another lender, they have 1 month of turnaround earnings and they decide to keep the deal. So I do think there is a lot of money chasing not that many good deals. On the other hand, I think the press would have you believe that our economy is much more robust than it is. I think we've had a lot of gyration in earnings. We've got good earnings for 2 months, and then people see it fall off the cliff for a month, and people, these companies don't see consistency in the growth. I do think like you have some industries coming back, but it's not it's not roaring back, and even in unemployment comes down, people are not getting jobs where they were earning as much money as before, and so I don't think spending is as robust, which we all know is going to drive the economy. So first quarter is always kind of slow compared. I know we do most. That's probably our hugest quarter is the fourth quarter, and but we are seeing some deal flow, but I question where our growth is going to be going forward this year. It's going to be, I think, better than last year, but I don't think hugely better.
Terrific. Carolyn, you have a terrific background with Willkie Farr in addition to the Venable firm. And the next slide that's up here, it shows a lot of the institutional loan default rates and what's occurred in the past and the recent history. I'd love to get your perspective on the changes in the bankruptcy code, how that's affecting certain of the conditions in the market. And then in terms of acquiring assets, what do you see as the trend in terms of 363 sales, Article 9, all that sort of thing?
Okay. First, the interesting thing, the last big amendments were in 2005, and certainly you saw some, and I'm just looking at which chart I'm looking at here, the default ones. I was going back to some of the older charts I was looking at. You saw an uptick in bankruptcy files in 2005. You don't see it on that chart, but one of the other charts I was looking at today. With respect to the default rates, because people wanted to get in before the code modification for 2005, and then we jumped to 2008, the next obvious big event, Lehman filing, and you see the default rate increasing in end of 2008 and 9 and 10. Obviously, we had a lot of liquidity crunch there. There was not enough liquidity to go around. You had a lot of defaults. Markets were, complete recession going on. But what's happening as the economy slowly turns around and starts improving, and it really appears from what I talk to my clients, you now have an excess of liquidity in the market right now. Banks are not running to unload defaulted loans because default rates are down. Defaults have gone down the last quarter of 2012. They continue to be down in 2013. And so for distressed investors, it's a little bit tough because banks are not trying to unload defaulted situations. With respect to bankruptcy, though, again, I go back to you need liquidity to file for bankruptcies. You no longer have, because of the 2005 revisions, these long, drawn-out bankruptcies. Lenders, companies are looking at bankruptcies just for purposes of, for the most part, disposing of assets. And it's just one of the options nowadays. As I mentioned before, we've been seeing in the last few years a lot of investors and companies getting involved with out-of-court disposition of assets. And I can talk about a little bit here and in a little bit more detail later on. But because bankruptcies are so expensive, and I hate to say that as a lawyer, but it is, the other alternatives available have just been, people have been very creative with coming up with alternatives, and therefore bankruptcies are down, although you're going to start seeing an uptick in the energy sector, right? You have TXU circling the drain. You had an involuntary filed against another energy last month. There are certain situations where bankruptcy is the only option. And the reason I say that is when you have operational issues, when you have large legacy costs and expensive leases you want to get out of, when you're downsizing operation, those kind of issues are best addressed through a bankruptcy proceeding. So you will continue to see those, but you often see cases now being filed on a fast track, either for an asset sale or a pre-pack or something like that. Otherwise, if for the smaller middle market companies, a company that's just trying to restructure its balance sheet, it oftentimes can try and do something like that, or a distressed investor can hop in doing it outside of bankruptcy. And there are risks involved with that, which we can talk about later. But that's what we're seeing here. And as defaults go down, as we're seeing in this chart, you're just going to see less opportunities out there. But again, we do expect that to change.
Terrific. And Gail, you know, with the more of the out-of-court workout type situations, especially some of the Article 9 activities that are beginning to happen on a more frequent basis, I was curious, what are some of the parameters you have to deal with from a regulatory standpoint that you can lend under? How does it impact your structures? And what are the key issues for helping you get a deal approved for financing?
As everyone knows, banks are a heavy regulated industry. And so one of the things that happens is if we have a company that, so we look at situations like private equity firms that are known to be distressed buyers, like a Platinum, a Gores, a Sun Capital, a Monomoy. We finance a lot of those deals for those companies, buying companies out of bankruptcy. And if you have a company that has 3 years of losses, by banking definition, that is classified as substandard, and you cannot book a substandard deal on purpose. You have to be able to elevate it one level to the other assets, especially mentioned level, to be able to book it. And so that rule requires an extra 20% of liquidity. And whether that is a private equity, you know, because we get a lot of situations where it's either 3 years of losses and no evidence of turnaround, or maybe just 1 or 2 quarters of turnaround, so we don't have anything audited. And so usually how that affects the structure is we need 20% extra, whether that's reserved out of the borrowing base, an LC, a capital call offered from a private equity firm, if they're individual entrepreneurs or privately owned. Many of them have an LLC where they buy property and lease it to the company, and so maybe you'll have a personal guarantee secured by collateral that you're not already lending on. So you've got to have something extra in case the turnaround doesn't continue. What we've been very good at structuring is that you know, if they're projected to get into a, you know, having a turnaround situation for the end of the year, we'll release those things once I get an audited statement, and either it's net income positive or very strong cash flow if the losses are really because of PIKed interest or something like that. But that is key in a turnaround situation. There has to be, as someone was already saying, if you're going to go into bankruptcy, you have to have liquidity, but we're not taking an equity risk. We're a senior lender, and so we are going to want to know that there is some extra cushion. So on the private equity side, we want to know how much dry powder there's left in their fund. Do they have any any particular limits on how much they can invest in one company. It's even better if they've purchased companies before and turned them around. So I think it's much harder to lend into a management team that's never seen a downturn.
Gotcha.
So those are some of the situations that we look for, and you're going to, all these adjustments that we get to EBITDA. You shut down a plant and you have two plants and consolidate to one. That you can justify as an add back to EBITDA. Telling us that there's just going to be less travel or something that's not as easily verified, that's going to get thrown out. So EBITDA adjustments are going to be very important, that there's stuff that can be verified.
Terrific. Susan, going on back to you, with regard to what is Versa's investment criteria, and how does a firm like Versa differentiate itself from other both distressed funds and also fundless sponsors?
So, as you mentioned, I think earlier when you introduced us, we're looking at distressed distressed and special situations deals, and that might entail a company that's doing negative EBITDA and bleeding, to companies that are divestitures that need management teams, which I would put in the special situations category, anywhere with $50 million in revenue up to $1 billion. And it sounds like a huge range, but it really depends on industry to industry. A retailer that's doing $1 billion is not the same as a machine manufacturer that's doing $1 billion. So that's why the number ranges so much. We're relatively industry agnostic, but I would say our main criteria is the distressed investor. We're really, in some ways, deep value players. And going, I think, back to Gail's point of when they are looking at underwriting deals as a lender, probably in a situation where it's distressed and turnaround is really an important story. There's usually more capital required by the equity investor, which is something we generally expect. And I would say the way we tend to differentiate ourselves is it's not a situation where it's easily refinanceable. There's not a lot of, there are working capital deficits. Really, our model is speed and certainty. So there are a lot of times that we actually come in and write the entire check, whether it's debt and equity or debt to bridge to an equity investment, and do that quickly, because a lot of the companies that we're looking at are draining cash. So, and then I think just to add on to some of the things that Carolyn and Gail were mentioning with regards to bankruptcy, I think what you were hearing Carolyn saying earlier was that now, today, what we are seeing is when companies are filing for bankruptcy, and we do tend to buy out of bankruptcy, and sometimes we're the ones buying into the debt or in the debt and converting a company almost the last option, which was not the case, I think, pre-2009. You would see bankruptcies filed earlier because cash was more available, but I think investors have also gotten smarter so that if you are going into bankruptcy, the question that's generally asked is what is it that you're really trying to accomplish? And as the panelist has mentioned previously, there's also a lot of liquidity in the market today. So what happens, companies are getting refinanced, probably maybe shouldn't be refinanced, maybe, they need to go through a bankruptcy, but they're not because they're kind of puddling along. And, there's a lot more cost-benefit analysis being done before companies are filing Chapter 11. So what we are seeing is that pre-packs are probably, the companies that we are seeing that are filing are mostly have prepackaged deals. There's an equity investor even in the debt prior to them filing, because everything's been kind of lined up. And to Carolyn's point, I think it is very difficult for companies to file given the cost. and the fact that, for a retailer, for example, post, pre-2005, they had a lot more than, obviously more than 210 days to get all of their leases in order. And actually a company that's, in the market right now that I think everyone is watching is Radio Shack. They have 5,000 locations, and they probably have a long way to go before they file bankruptcy, but is that a company that might have filed, pre-2005 to deal with their 5,000 leases and sat in bankruptcy for a while, for years to do that? They certainly don't have an option to do that today. So I think there's a number of factors that are, causing companies to kind of stay where they are, which is the refinancing market is hot, and the bankruptcy laws don't really allow, it's not as easy for a company to survive in a short-term bankruptcy unless they have a very good plan going into it.
Well, you bring up an interesting point because you said the 5,000 locations of Radio Shack. I have heard people comment that they don't think Best Buy will make it because people use it as a showroom and then go buy it online. And so there is a question of future bankruptcies. Are retailers really going to be able to keep all their locations? And, JCPenney's is having problems. I mean, it's, everybody that has all this real estate, will they survive?
Well, and I don't think the bankruptcy laws, historically they were able to file, and especially with these really large retailers, unless they have a really, they either have buyers lined up for their leases or something before filing a bankruptcy. 210 days is just not really enough time to deal with that number of leases or the size of some of these leases.
That's exactly right, Suzanne. And not only that, back in the day, again, going back to my 1990s, filing a whole bunch of retailers, we used to be able to extend our time to assume that reject the leases for non-residential commercial property through confirmation, and that would be years out. And the argument was that we had to put our business plan into effect and go through a holiday season at least once and then modify the business plan before you could develop your plan of reorganization. And as Suzanne just mentioned, the 2005 capped that period at 210 days. But it's shorter than that because when you're looking for financing, your lenders need you to make a decision as to which way your company's going before that, so they still have enough time to liquidate those leases. So it really puts a really short time frame on a retailer's ability to determine the best business plan and how to dispose of their real property and leases. So it's caused a big problem, at least for right now, until the market turns around. Landlords' councils always say to me, well, at some point we'll continually agree to extend the time, which they've done for now, and then at a certain point when there's an abundance of tenants, they'll no longer agree to that. But lenders aren't willing to put their hands in the hands of landlords that they'll get all these extensions, and therefore the ability to restructure retailers with that amount of locations is very difficult.
So let's move on and talk a little bit about sourcing deals. Carolyn, I'm going to do a follow-up question on you because historically it used to be that when somebody was having trouble, they immediately went to a debtor counsel. And so we would normally I just needed to know a bunch of bankruptcy attorneys and off I would go. But it seems that now there's not as many filings. There's a hesitancy to show that it is a distressed asset. But yet I know that my understanding is for a lot of folks like yourselves, you're getting more involved in corporate governance. On the transaction side, you're seeing deals. You're participating on the transaction of distressed assets. How do you source deals? Where do you find your distressed opportunities coming from?
Well, what's interesting is not an investment banker, but I feel like one sometimes because I'm very involved with the private equity space, and I get phone calls from people saying, I have CROs that are calling me up saying, can you give me some guidance to lender sources that are looking to invest in this industry? And then I have my lender contacts calling me up and saying, hey, I'm a little slow on deals. Have you heard anything? On the other end, or, looking for this kind of investment criteria, do you have anything that you are working on? it's very interesting that that's how a lot of the stuff is coming to my plate and before. And then I have my usual private equity clients that just get involved with a deal, and they call me up and they just need assistance with it. But what also happens is companies are very concerned on the corporate governance front with breaches of fiduciary duties, and so they know that when you're bankruptcy counsel to debtors, you have to understand what happens and how do duties shift, or do they shift in the zone of insolvency. So people will call us up for just guidance when a company is in distress, and oftentimes maybe there's a financial advisor already in place, or a CRO I know, or someone that's heard about us, and they call and they just ask you to come in to advise a board on what their fiduciary duties are in a current status, depending on where their finances are at a certain point of time. So we'll go in and just do that for them and give them some guidance as to how they should be making those decisions and what their duties are.
It's an interesting update. And Gail, from your perspective, are you seeing any particular sectors or regions of the country where there's more activity than not? It seems like we've gone through the housing industry, the construction industry. It seems to be wrapping up in some ways. Some of those are being refinanced for hoping for future growth. Are there any other, you had mentioned retail earlier, any other areas that we should be focusing in on for potential opportunities?
Well, I think somebody mentioned energy, and that's a very cyclical business. And so far haven't seen problems, but we're watching that closely as lenders. We are still, even when the downturn happened in 09 and 10, we thought we would really get hit on the automotive, and we actually did very well there. Where we did get hit was building products. But so we're starting to see anything tied to housing start. These aren't huge gains, but we are seeing some growth in companies that service that, because the market is very tight. There hasn't been any building, and so there's some building starting to go on. So, and I think anything related to healthcare, you just have an aging population, and we're seeing things that are related to that.
George, I'm just going to agree with Gail on that. I was just talking with my Washington, D.C. colleagues, because we get daily updates on what's happening on Capitol Hill. And with sequestration coming up in 4 days, my PE guys are looking to that as well to say, where are the cuts going to happen, right? So if you're looking at it even from a legislative standpoint, where you see government cuts coming, and loss of subsidies and increase in taxes, it hits the energy sector, right? So there's a lot of subsidies that would have been otherwise going to the energy sector that might go away. You see it in possibly coming up now, the military over the next few years when the budget gets cut there. So ancillary services related to those cuts are going to impact what markets distressed investors are going to want to go to, because obviously wherever there's going to be strain, that's where your best opportunities are going to be. So I agree on the energy sector for sure. On the military, it's going to be coming up. Media is still out there. I'm hearing things about. And healthcare, because of all the government policies and the healthcare reform, you're going to see stuff there as well.
Right, I definitely agree on that military thing. I think the returning troops, anything where they've been providing things to the products to the troops, those guys are going to get hit.
And Suzanne, you've got a unique situation, because as I recall speaking with you, you look at 400 deals a year. I think you said you booked 7 last year, 4 were sourced last year. And what's the main source of your finding the deals that work? Is it investment bankers? Is it CROs? Is it attorneys? And what is your preferred way to find a deal?
Well, it's definitely a combination of all of the above. When I think about all the deals that we closed, they're over just the last 3 years. Let's use that as an average. We have seen them from CROs, attorneys, and banks directly. So it does come from everywhere, although it is all most of it, other than a bad management situation or fraud, is really driven by cyclicality in the debt market. So, you know, our peak year was 2011, where we started looking at deals in 2010. So,
now, you had indicated you work in various parts of the capital structure. So, but you eventually want to be able to own and control the company.
yeah.
Does that preclude your willingness to do some mezzanine money in a distressed deal?
No, not if there's equity beneath us, or we wouldn't be the control, you know, mezzanine player. I think ultimately what we have done historically is we've provided DIP financings and bridge loans, and sometimes the you know, ROIs on just the loan itself is enough to get us interested, because it might not be the right fit for an institution like PNC. And with the backstop of, if this goes bad, generally with returns that high, there's a high degree of risk involved in the loans we're looking at. We backstop that underwriting to say, okay, if it goes bad, we're comfortable owning the company, but we don't necessarily have to go that way. So a lot of the deals that we do get involved in are companies where we're providing a front-end solution to a potential, you know, an exit strategy. So, for example, we actually had a company where we were in the senior debt, and we anticipated that we would be refinanced out, and we actually were refinanced out within an 18-month period. So that's a little bit unique for us, but we certainly do that.
Okay, that's terrific. Let's move on to determining a little bit about valuations and how much to pay in an asset. And Carolyn, I'm going to put you a little bit on the spot here, but one of the things that I've seen as a trend over the last, let's call it 5 years or so, is the value of intellectual property, trademarks, brands, and marks, and so on, that have really made a difference in kind of what ended up being the value in terms of both financing and attracting capital to assets. Have you seen any trends in that and people taking more advantage of that?
Absolutely. Companies are being looked at very differently, and different assets are being viewed in the last few years. IP and trademarks have been very key assets that investors have been looking at, and obviously look at Kodak, right? Perfect case for an example of how important IP and trademarks are for the value of that company. So we have different ways of valuing it, and I'll defer to the business people who really do the valuations. But I know that my IP group gets involved with our clients' evaluation of the value, because they'll go, you know, not so much for a big company like Trademark where their legal issues are pretty well known. But as you go smaller into the smaller middle market, you really need to look deep into the trademarks, how they're filed, the quality of the filings, the timing, and really understand them from a legal perspective to understand their worth. So I've gotten my IP group involved with assisting clients in valuing the IPs.
Good to know. So this next question, actually, I'm directing it both to Gail and to Suzanne. You know, I get involved in these companies. They have negatives, sometimes negative to zero EBITDA. I'm working on a pro forma set of financials to get them from point A to point B. There may or may not be heavy assets involved. I'm always looking for the additional values like intellectual property and so on. But a lot of the value is based on pro forma frequently about where we think the company is going to be. Suzanne, how do you even begin to determine what the value should be, how much remaining value there might be for the remaining equity, and how much money to put in versus how much the bank wants you to put in?
So, you know, that's actually a really good question, because it's obviously an area that we spend a tremendous amount of time on in our underwriting efforts. And I would say, you know, again, it depends on industry to industry. And you mentioned, and Carolyn mentioned, IP assets, which are also very important in terms of valuing a company. I think just as a general rule of thumb, when we're looking at a company that is losing $20 million a year, for example, and, you know, I think we have to make a judgment call on whether or not we can get it to a break even and then positive EBITDA within a reasonable amount of time. And I don't know, it might be 6 months, maybe 12 months, maybe 18 months, but the valuation that occurs in those instances is really benchmarking to how quickly can we get the company turned around, our view of how quickly we can get it turned around, and what the stabilized EBITDA number might be. Because, and then as you may, you might imagine, the number that we purchased the company for is most likely not all of the capital that is going into the company, because again, in situations like that, we're obviously putting in a lot of capital post-close, and many banks won't even lend into situations like that, so we're generally the only capital for a relatively good amount of time until we're able to bring in a lending partner. So, valuation, we've had companies where we just actually had a company last year. We purchased as a divestiture, and, we were paid by the parent company to take on the risk of operating the assets as a going concern. So sometimes it's not that we're making the payments, but, it may be that someone's paying us. That's a very unique situation, but it can go that route. To the other extreme, which is, we're paying for the assets of the company, and that's really when there is an asset-rich company, we can say worst case scenario, if we liquidate the company and it doesn't work out, what are we going to get those assets? What can we get back out of those assets? And then, on top of that, the money that we're going to have to put in to try to turn the company around. So it can get very complicated, but that's probably the 2-second version of how we value companies.
So Gail, what determines how far you'll go? You had mentioned earlier that you've got some brand name private equity distressed investors that you'll go pretty far with because you've experience with them and you know the kind of how much kind of support they can provide on it. With a first-term kind of opportunistic fundless sponsor, does that change how you view the deal, and would they be better off partnering with a large firm?
I would think in most cases they're going to be better off partnering with a large firm, because if you're just in the midst of a turnaround situation or you've got a situation with a cash burn, and we finance deals with still a cash burn, but those are usually private equity situations, so that if the burn is larger than anticipated or it doesn't happen as projected, you think it's going to burn for 6 months and it ends up happening 12 or 18, that there's another source of capital. Because we're not going to equity investor, because if a fundless sponsor, if they don't have any money to put in, they don't bring a partner. We work with a lot of fundless sponsors, but they'll hook up with another fund, and so they'll have a percentage of the ownership and bring somebody with a fund to invest with them. We really look at the potential of improvement, because there's been a lot of situations where somebody tries to do a roll-up and it's a busted situation and they need to sell it off or close it down, and so they may have had earnings before they once this thing is closed down, they'll return to their normal operating business. Or maybe they lost a huge client and they now have a new contract, and so there is a justified backlog, even though they may be in a burn. But we're just not going to, we never go into a situation where we think, like the old days, the old Foothill would have said, you know what, we don't care if this is going to end up in liquidation. We'll lend to it anyway. If it ends up, we'll just liquidate it. Nobody is that kind of lender, not one that's owned by a bank anyway. And there are hedge funds that are loan to own. And a lot of situations, especially if there's no assets but there's a good story, a lot of these hedge funds funded, and they'll be maybe at LIBOR 8 with 1 or 2% floor, and then they look for somebody like me that they'll give a first out to, and I may do it at LIBOR 3 or 350, and so they'll skim me to be able to lower their rate or bump their yield. But in a liquidation, I get out first. And so those are kind of situations. On IP, we don't typically lend on it, but we might lend some air, and we'll have that valued, because the lender's experience, there was an old deal called Tri-Valley that was vegetable and fruit, and had we just had the AR and inventory, we would all taken a hit, but they owned the brands of S&W and Libby, and they sold those, and that's what took us out. But that was boot collateral. That wasn't something we were actually lending on. But the intellectual property, and somebody mentioned this, having it registered properly, we always depend on our lawyers to make sure that everything that needs to be done on intellectual property is done, in case you need it.
Speaking of lawyers, let's go on to the next area and talk about best options for purchasing assets. And Carolyn, I'd like to direct this to you, because with the various options that are out there, depending where the economy is, depending where the bankruptcy code is, how do you begin to advise a client on what is the best option for structuring the acquisition?
Well, it's funny, I'm looking at this slide, George, and I teach a workouts course at NYU's continuing professional studies, and this is a whole 2-hour course in and of itself. So I will try and get it down to just a couple of minutes here for this group. Depending where, advising a debtor, let's take it from the company side. So you're a company and you're in financial distress, and we go through all of these permutations as to what is the best option for the debtor in that situation. Then you put on my other hat as distressed investors counsel, and they want to acquire the company. And we go through, and that's where your question lies. And then, of course, I also represent lenders that are holding debt of a financially distressed company, and that's a little bit different. Taking it when I'm advising someone wanting to invest in a distressed company, bankruptcy is your safest method as far as protecting you from successor liability, getting assets free and clear, having the automatic stay put into place, ridding yourself of leases and contracts that are no longer profitable, so you're able to reject them. There's a whole lot of benefits putting a company through Chapter 11 and acquiring them through a 363 sale or a Chapter 11 plan, acquiring them either way that benefits a client. Now you get to the practicalities, which is cost, time, effect to the reputation of the companies. There's a lot of negatives to this. So you really want to, as Suzanne said, it has become the last alternative for people. There are certain situations where you cannot turn around a company without taking it through the Chapter 11 process, okay? So if you have a lot of leases and you want to shed, your very complicated structure, maybe the corporate structure and capital structure is very complicated, you're probably going to need a Chapter 11 case. But absent that, the other alternatives, if it's a simpler company and you're trying to, let's say, buy the equity and there's a lender out there, or you're just trying to buy certain non-core assets, or you're trying to buy all the assets of the company as opposed to buying the company itself to try and avoid legacy costs. One of the things I advise them is, obviously set this up in the best way, looking at successor liability factors to try and ensure that my client is not going to be stuck with legacy costs and other successor liability, right? So you want to have it be as different from the prior company as possible. You can go to an Article 9 disposition, and what we would do there is we would find out who the lender is and go to that lender, and if that lender isn't interested in having a loan-to-own situation and really just wants to dispose of the property, you can go to that lender and try and work out a friendly disposition where you can get fair market values, get appraisers, and try and have it, you have an auction. You can have a private sale, you can have a public sale, but once it goes through that foreclosure, that helps to protect you from fraudulent conveyance risks, right? Because there's the BFB case that says a properly conducted foreclosure sale is going to be deemed fair market value. So that should help you as long as it's done properly. Other options, which are really done mostly, I've heard of in California, some of my colleagues there have done it, and we've done it elsewhere, but it's certainly prevalent in California, is the ABC, Assignment for the Benefit of Creditors. And I think of it a lot like a Chapter 7 liquidation, except it has some key benefits in that usually you can pick the assignee as opposed to the Chapter 7 liquidation where a Chapter 7 trustee is just appointed and you don't have much say in it. That's one of the key benefits, and usually you will try and I know I'm saying this in public here, so I need to be careful, orchestrate the transaction in the way best possible for my client, again, while trying to protect them from legacy liability and make sure there's enough, differentiations and following the successor liability factors to protect them. So we'll go out and get 2 appraisals, independent appraisals, to make sure they're paying fair market value. But that, again, is a very nice way to acquire assets or a company without having to go through bankruptcy. The risks there during this process there are litigations going on because they're not stayed. During this process, you could have creditors go in and file the company for an involuntary bankruptcy. During this process, or after this process, I should say, under state court, there are state laws, there are fraudulent conveyance or preference statutes, and so people can go and challenge the transactions. So you don't have all of the protections and all of the tools of a Chapter 11. You really need to look at the company you're trying to acquire, how many creditors there are, what are the unique issues involved there, and make it on a case-by-case basis as to which of those alternatives may work for you and be a more efficient and less costly manner to proceed in.
We're going to see if we can talk the sponsors into a 2-hour seminar for our next program. We're fast coming up on our hour, and I know I was asked by the sponsors to see if there were any questions that were being asked by the attendees. I'm going to check with that with Kristen. Do you have any questions, Kristen?
Yes, there is a question in regards to distressed software companies whose assets are IP-oriented. And the question is, how can these companies be restructured and refinanced into the mainstream models? Does anyone want to try and tackle that in regards to software companies?
Kristen, I'm sorry, there's an echo with your. There's an echo when you were talking. Can you repeat that question again?
Yes. So the question is in regards to distressed software companies whose assets are IP-oriented. How can these companies be restructured and refinanced within the mainstream models?
I can take a crack at scale. Okay, one of the things we looked with on software is usually they sell the software and then they have a maintenance contract, and they have a recurring revenue stream. I think the only chance you have for refinancing, and you have to understand why the company is in distress, but we look for that recurring revenue to have a very high renewal rate. So I think the worst cases you're going to look at is 85% renewal rate. You prefer 95 and above. So that would be my first question. If you're below the 85% renewal rate on maintenance contracts, and I'm assuming that's the kind of software your company you're talking about, if not, you're probably going to have to be looking for an investor because again, you're going to have to understand what's wrong with the company. But that's how we've looked at software companies, and so there's not too much refinancing of distressed without some new money or a clear path of that they had this problem, but they fixed it and they're going in the right direction.
Wow, that was a great Stump the Stars question. Are there any others, Kristen?
Someone asked if there are any examples of distressed software where the company is not EBITDA positive. If anyone's ever dealt with that.
And that's again a software company?
distressed software where the user, I'm sorry, I couldn't get the last part of your question, Kristen.
Where the company is not EBITDA positive.
Is that for software or any type of company?
I would say we could open it up to either.
Okay.
But the question was in regards to software.
Suzanne, will you invest in a company that's not EBITDA positive?
We have, and actually we've looked at a number of companies in the technology space and actually own a company in the technology space that wasn't EBITDA. We purchased it when it was not EBITDA positive. And one of the reasons we did was because we realized that the company was selling its software and some of the selling some of the products at, you know, in order to gain revenues at really a loss. And so as soon as we were able to cut out any contracts that the company was selling at a loss, we were able to take it to break even, and then, you know, shortly thereafter, positive EBITDA. So I think that it depends, and obviously software is a very, very broad space. So it's difficult to say. I don't know what in particular you're referring to, but you know, you could talk about software from video gaming assets all the way to office software. So, but I actually wouldn't say that would be that different to us with any of those categories.
Wow. Well, and Gail, just on the quick, would you finance anything that's EBITDA negative?
Yes, if I have a clear story of how it's going to right itself, and if anything falls out of the plan, that there's somewhere to draw from some extra liquidity if it doesn't turn around as projected.
Well, terrific. Why don't we wrap this up? Because I know we've finished up our hour with anything, and starting with Carolyn. But just a real quick on any quick takeaways, best practices, Carolyn.
It really is. You need to look at what you're trying, the company you're trying to acquire, and it's very fact specific. There is not a cookie cutter answer here. Investing in distressed assets is not for the meek or lighthearted here. But once, you know, you need to get your group of professionals involved to really analyze your situation to figure out which is the best way for you to acquire assets.
And Gail, what do you think about takeaways for financing on these kinds of deals?
You know, be professional with your presentation. If you don't have the ability to do it in-house, then, you know, hire somebody who can help you. But understand your numbers, understand why you're at negative EBITDA. Have a good story as to how you're going to get out of a negative EBITDA that can be documented. You have additional orders. There was a problem that you've now taken care of. You have one chance to make the story good, make it professional, and any EBITDA add backs, however you're going to fix the problem, they have to be situations that can be verified, not, you know, we're going to get new sales.
And Suzanne,
if you don't have the pardon
go ahead.
me. You know, you have to have done some homework and have some orders in place.
Got it. And Suzanne, what about from a private equity distressed investor standpoint?
Well, I guess I would just take it from the standpoint of, if this is your first forte into distressed investing, I'm going to, repeat basically what Gail and Carolyn said, is you should make sure you have the right advisors, because it can be a very complicated process. And frankly, I have seen a number of companies with probably not the right advisors and maybe not the right bankruptcy attorneys or counsel, and they've gotten bad advice and it's ended up very badly for them. So I would, call as many people as you can and make sure you have qualified advisors.
Well, terrific. Well, I want to thank the attendees for allowing us to participate in this hour in your day, and I'll hand it back to Kristen.
Yes, I just want to say a final thank you to all of our panelists, and to you, George, for moderating, and again to Opus Connect and Venable for collaborating with us on this effort. So with that, I think that's a wrap. So thank you again to everyone for attending, and to our panelists and to our moderator.
Thank you. Bye-bye.
Thank you, everyone.